Operations break-evens. Kevin grew up on a purebred cow-calf operation and graduated from Kansas State with a bachelor's degree in animal science. While he is at Kansas State, he is a member of both the meats and livestock judging team. Kevin, we'll turn it over to you.
Thank you. It's good to be with you this morning. Well, over the next hour that we spend together, I want to touch on a lot of subjects. And as we think about where we're at today in the cattle market, it's a good time to be in our business, isn't it? As you think about where we're at from a cycle standpoint, not only are we expanding, but the segments of our business pretty much from top to bottom right now are profitable. You know, that said, there are some challenges out there. As we think about some of the challenges that we're going to face, as we think about large total protein supplies, the uncertainty of trade, you know, as we think about some of those issues, I want to walk through the presentation this morning, and we'll start out and basically kind of ask three questions. You know, we're going to call them the cardinal rules for the cow-calf. You can say the seed stock producer as well. But number one, think about those folks that are in the segments of the business that you're not involved in, as it goes from the seed stock all the way to the consumer. Are they profitable? Is there enough dollars flowing into our business that every segment can be profitable as we go forward? Or is there enough dollars flowing in, but more of those dollars being held at different segments because of some of the leverage issues that we have? And we'll talk about that in more detail. So that's a question that we need to answer as we go forward. Number two, where are we at from a supply and demand situation? As we think about where we're at from expansion, we know we've got a lot more cattle, but we've also got more pork and poultry as well. And what does that mean for us today? Today, prices are holding up very well. But as we go forward in here, will that mean that at some point prices have to diminish back to a point where we don't have profitability and therefore stop to expand? And the third question we're going to ask is talk about the structure of the market from a commodities complex or a future standpoint. Today we've got a very odd situation. We've got some very large premiums built into the live cattle and the futures and the feeder cattle futures. What does that mean to us? Will they stay there? It's almost the opposite of what we've had the last couple of years, and that structure of the market typically tells us that there's something in front of us that we might not like when you build the big premiums. So those are some of the questions that we want to answer as we go forward here. I've got a little echo. I'm going to see if I can turn that off. I don't know if we can do that or not. Are you catching an echo in the back or not? You all right? Okay. So as we go forward, let's start and talk about where we're at from a big picture standpoint, from an expansion standpoint, and also the profitability piece of the other segments in our business. Number one, let's start and talk about where we're at if you think about a weather pattern. Here in the South, you've been blessed as we think about actually too much moisture at certain times. But generally speaking, since 2014, Mother Nature has smiled on us in the cow country, hasn't she? We've had tremendously good moisture. You know, the exception would be the northern plains as we think about the Dakotas, what they've experienced in Montana this summer. But generally speaking, after the drought was broken, we've had a very good string of years of adequate moisture. Just as we think about going into 2018, we used Dr. Art Douglas as our climatologist. He would suggest that the weather patterns are starting to shift, and he would be a little bit in the camp of a La Nina as we go into 2018. So especially in the winter period, he would have us probably drier and a little bit warmer than normal as we think about the southern one-third of the U.S. as we go forward in here. Input costs are tremendously important, aren't they? Not only for cattle business, but also for pork and poultry production as well. As we think about corn values, and we're going to use that as a proxy for feed cost, you can see a tremendous amount of volatility if you look at 2007 to 2013, can't you? Now, what happened in that time frame? Well, number one, we increased corn demand by 5 billion bushels with the onslaught of increased ethanol production. And so as we increased demand for corn, it took the U.S. farmer a number of years to increase the supply, a bigger crop. And finally, we've done that over the last 3 to 4 years, and you can see that the supply and demand are more imbalanced, and so prices have came back down, and they've been more predictable, a tighter range. And so as you think about where we're at today as we're finishing up harvest, we've got a crop that's going into the bin that would suggest that our stocks-to-use ratio will be as big or bigger than it was a year ago, on top of 16%, which would suggest that we'll have adequate corn supplies, feed grain supplies as we go into 2018, and that our projected range won't be a lot different. You know, in addition to big crops in the U.S., the world is awash in grains as well. The stocks to use, as we think about globally for corn, beans, and wheat, is rather high. And so there is a lot of product on the global market. But again, we need to remember we're only one drought away from seeing more of the volatility come back into the corn business. Another just tidbit as you think about the policy in China. They've came out and suggested that they also want to get in the ethanol production business. And if they do that, they would have a tendency to draw down their corn stocks, probably increase our corn exports, and have an upward bias as far as price. But generally speaking, input cost, whether we're talking about grains for production purposes or even hay and roughage, are still from a historical standpoint relatively low. Also recognize that if we talk about corn in particular, it has a bigger impact on the bottom line and profitability of both pork and poultry than it does beef, because a higher percentage of their production cost would be in the form of feed grains. Also, you look at that last slide, a lot of volatility between 2008 and 2013. And then you look at this slide, and this is just to illustrate the volatility. It just tells you how many dollars per head change week to week you have because of corn in the production cost of a fed steer or heifer in the feed yard. And the point I want to make here is, as we've gone through the last couple of years, there hasn't been as much volatility once that market has settled down, which is going to be the opposite of what we're going to see when we look at a similar chart for cattle prices here a little later in the presentation. I threw this slide in here just to give us a taste as far as energy cost. And in the dark line, the black line represents crude production of the U.S., and you can see it's gone from 5 billion barrels a day to now where it's 9 to 10 billion barrels a day over the last 7 to 8 years. So just give us a taste of what's taking place as we want to talk about that other component of input cost, energy. More than likely, with the increased production, we've got energy costs that are going to be more doable or more sustainable in here from a production standpoint, cost standpoint, will help the bottom line as we go forward. Calf values, and I throw this up here just to illustrate the point that if we talk about the cow-calf business and then we're going to look at the other segments, it's been a rather good year in contrast to where we were a year ago at the same time, isn't it? You know, today, if we think about a 5-weight steer calf, U.S. average somewhere in the mid-160s is where that would be today. A year ago, we were putting our lows in the 120s. And of course, we're going to talk about some of those differences as we go through this discussion this morning. But on average this year, we're going to end up averaging on top of 160. Look at the prices the last 30 days, the green line. You've got the red, which is a seasonal index on the left-hand axis, and on the right you've got the green, which is this year's prices, which also would correlate with last year's prices in blue. The market's held up stronger than it should have from a seasonal standpoint over the last 30 days, hasn't it? Why is that? We're in the midst of our calf run in most areas now. We've got a calf crop that's close to 1 million head bigger than a year ago, but nonetheless, calf values are holding together tremendously well. Well, we'll talk about that. Part of it is the premiums that I talked about in the feed futures and the live cattle futures. It's a fact that the stock or backgrounder a year ago made a tub of money, so there's a lot of demand, isn't there? Well-supported calf values are as we think about it today. From an industry breakdown, and on the far right-hand side is our expectations for 2018. The bar coming closer on this side is 2017, and you can see that the 4 different segments that we're going to look at, cow, calf, stock, or feedlot, and packing, all have had a good year. So you think about what's supporting values today. Part of it is the profitability that we've had this past 12 months. Also, we're going to center on that yellow portion of that bar here in a minute, talking about packer profits and some of the challenges that we have there from a capacity issue, because they have had the best run they've had in history from a profitability standpoint. So part of the answer to the first question is that we do have a situation where everybody in the system has had a good go this past year, so there's profits. And with profits, that tends to be very supportive if we're talking about the cow business in particular. Year to date, we're just going to look at some numbers here, because we know that this is the 4th year of expansion. You go back historically, if we take the old 10-year cattle cycle, it would suggest between 4, 5, 6 years, you know, the cycle gets long in the tooth, and that you've got to expect to see the market pull back from a number standpoint. So we're looking at some of the data points to see if, well, are we expanding? Yes. Well, if we are, at what kind of a rate? Is it slowing or is it picking up the pace? Well, the two rectangular shaped numbers, starting with the heifer slaughter, which is up 12% year to date, that's a big increase year over year. But we'll look at it from a percentage standpoint, still suggests we are expanding from the heifer side. Cow slaughter, up 11%, the same. It's bigger than a year ago, but still at a rate that would suggest that we're expanding from the cow side as well. And I've also circled there oblong the fact that you think about beef production up 4%, cattle slaughter at the top up 6%. What's the difference? Weights. Weights have been down about 2% this year. So that's offset part of that increase in supply. And then just the fact, as you look at the number of cattle that are grading choice and prime, you can see that we're producing more choice and prime product than we've had in the past as well, year over year. So looking at the cow slaughter first, and you think about this year, it's going to be up about 400,000 head. Despite that, that's still at an expansion rate, but it's slowing. And in particular, you can see it with the drought in the north. You're starting to run a few more cows there. You know, some of those things that you're seeing. So you can say that, well, logically, we've probably got more cows in front of us with a bigger cow herd. We would expect, as we go over the next 2 to 3 years, to see cow slaughter pick up. You know, we're going to talk about in a little more detail in the fed than the non-fed, but we've got a challenge from a capacity issue in the cow plants too, don't we? We're maxed out, especially this time of year. And then we talk about the profitability there. There's a tremendous amount of profitability in that particular segment. So on the cow side, we're still expanding, but at a slower pace. You can say the same is true for heifers. And here we're just looking at the heifer slaughter as percentage of total slaughter. Typically, you can see the long-term average at 37.2, but typically when you get to 36%, that's a spot where you're still expanding but very slowly, and then by the time you get to 37% or above, you're liquidating. The report that came out last Friday, cattle on feed, heifers on feed are at 35.9%, almost approaching that 36% level. And so what that tells us that we are slowing the pace, and you can see our expectations over the next couple of years is that we will get to that point where we stop to expand from the heifer side, but that's not there today. But it does say that we are slowing the pace. So for this purposes, just laying out in a 2018 forecast up 790,000 head. What that is the January 1st, 2018 report. So it would reflect the expansion that we're going through today in 2017. So we are expanding rather rapidly this year, not as quickly as a year ago. And you can see that we would forecast going through next year increase of a couple 100,000, but slowing the pace. And so over the next 12 to 24 months, we would suggest that cow herd expansion will slow and then stop. Now, we'll talk about prices when we finish up, because when you start looking at the average cost of production of a calf, it tells us that prices have to get quite a bit tougher than they are today for that to occur. Or Mother Nature would have to have a change of course as we think about weather patterns. A couple points I want to make here. You know, I talked about the old 10-year cattle cycle. Think about what has occurred over the last 20 years. From 1996 to 2013, we liquidated 16 of 18 years. The last 4 years of that liquidation calf prices were strong enough, we should have been expanding. And we actually were expanding in the northern plains. But it was trumped because of Mother Nature, because of the drought. And so we've had a prolonged liquidation cycle. And I'm just asking the question, I don't know the answer, but does that mean we potentially could have a prolonged expansion cycle? In other words, the fourth year that we're in, we might have a couple more years in front of us where we'd expand. You can see we would have numbers going back to a little over 32 million head. You can see some of those old spots, you know, the low in the late 80s, early 90s at 32.5, and then the launch point in 2006, which was the last mini cycle peak that we'll talk about in more detail. That would suggest maybe there's room for another 500,000 head out there. So using that 2006 to 2013 as kind of as a proxy as far as that last drop, let's just say, where did the cattle liquidate from and where are they coming back into, looking at beef cows? So between 2014 and 17, this would be the expansion, or we should say restocking, in a lot of areas of the country that we've seen by region. And of course, it's been led by the southern plains, primarily Texas. You know, 1.159 million head increase. In the geographical areas, the Midwest would be another spot we've seen quite a bit of repopulation, primarily in Missouri, in that particular state. Now, another way to look at this, though, as we think about this is the increase in that central area that we saw in the last 3 years. Well, how much room do we still have to get back to that 2006 level? And so here we're using 2006 as a base, and the red line represents the southern plains. And you can see after almost a 2 million head drop, we're back quite a ways, but we still have quite a bit of room. And you can also see the same in the southeast. You know, I mentioned that the northern plains, in this case, if you look at the northern plains, it's the yellow line. You can see between 2010 and 2014, they were actually expanding because they did have better moisture conditions, and calf values were stout enough in those years that it warranted some expansion. This is where we can still grow the herd to get back to 2006 numbers. Will we get all the way back there? I don't know if we know the answer to that. When we think about some of the other challenges we have from land use, whether it's urban sprawl, and whether we think it's alternative crops, you know, there's a lot of headwinds as far as getting our herd a lot bigger from a geographical standpoint. But nonetheless, profitability is what rules the roost as we think about that decision. So this just gives us an idea as we come into this year where we still have room to see a bigger herd. And again, not surprising to everybody in this room is that the southern plains, particularly Texas, is an area where we can continue to see quite a bit of repopulation to get back to those levels we saw in 2006. As we think about what this means from a production standpoint, just remember we've got a bigger calf crop going through the system, which means as we think about the slaughter levels, they're going to increase, aren't they? Well, just let's look in the rearview mirror for a minute first. And in this chart, we started at 2000. And that year, we harvested 30 million head of cattle, fed cattle. At the low point in 2015, we harvested 23 million, 7 million head drop. So where we're going to go with the next couple slides is what did that mean for that segment in our business, the packing segment, and what does that mean going forward as far as the dollars that are available from the consumer, how do they trickle down? Where are they held back? Who has the leverage in the system? You can see that a year ago we increased slaughter rates by 1.5 million. This year, 1.1 million. And you can see the forecast for 18, you know, we could go to 19 and 20. They'll stair step higher as long as you've got a bigger calf crop. So here we are at a spot where we got more cattle going through the system. At the same time, you've got a packing segment as an expanded. They're doing a little better job with what they've got. But generally speaking, here's just an illustration to move the cattle in the system that we have from a fed slaughter standpoint today. It tells us that they have to run more than a 40-hour week. In other words, they have to have enough profit incentive to run Saturdays. And you can see the percentage as it stair steps forward going through the next few years because of increased number going through the system, it means that they have to be incentivized to kill more and more cattle with the capacity they have. And this is an illustration, I think it ties in very well with that slaughter slide, because here we start at 2000 as well, and you can see as slaughter numbers decline, the packing segment loses ground from a financial standpoint for two reasons. Number one, they're not as efficient as far as running less cattle through a plant, but also they lose leverage. Those people in the system, primarily the feedlots, have leverage over them. And so they lost money. What do you do? Respond by closing capacity, closing packing plants. Improved financially in the 2009, 10, 11 area. Well, we harvested less cattle, they became less profitable, and so they closed quite a few plants. So the bottom line is, from 2000 to 2015, we shut down about 20,000 head a day capacity. You do the math, that's over 5 million head on a yearly basis. So we've got less capacity at a time frame now where we've got expanding numbers. So what happens? You can see the profitability they enjoyed last year and where they're at year to date. You know, it's a challenge, very good for that segment, but that's a spot in the system where there's going to be quite a bit of that dollars from the consumer left as we go forward over the next couple of years. What's this meant as we think about the leverage part, and here we're looking at the percentage of the cutout or wholesale price that the cattle feeder is receiving. And we're netting out the drop credit to try to compare apples to apples. And you can see when we had tight supplies in 12, 13, 14, 15, in that time frame, we were getting a bigger piece of the pie, weren't we? And the packers were very either not profitable or making very little money. Well, the opposite is true the last couple of years, and the way to read this, every 1% change in the leverage component is worth roughly about $30 a head to the cattle feeder. So it's huge. The leverage component the last 2 years is the big reason why we've had prices devaluate as much as they have. Yes, we've got bigger supplies, but when you look at demand, and we'll talk about demand in a few minutes, demand has stayed very robust. It's good. It's off its peak, but it's still very good from a historical standpoint. The leverage component that we're facing today, and I would contend we'll continue to face, is a real drawback as far as our potential over the next couple of years. I threw in a couple of weight slides just to recognize as we think about this past year, 2007. We came into this year where we had, after the disaster of last fall price-wise, the cattle feeder, as we came into this year, he had bought low enough break-evens that he was profitable. We had a discount futures complex, and we were buying a positive swap on feeders. In other words, we were buying a break-even below what we were selling the fat for. Those are we call the 3 cardinal rules of cattle feeders, which told us that we were going to do a good job of selling cattle, pulling them forward. We did exactly that. As you can see, our weights had the biggest decline from Jan to the spring low we've ever seen in our data. And what did the market do? It overperformed. It got better. And with that being said, think about where we're at today. We still have a cattle feeder that on average would be washing, maybe losing a little bit of money depending on where the market goes over the next few weeks. We are buying a negative swap on feeders. In other words, we're selling one last week for $1.11, and we're buying a break even on top of 120, 125. And we've got, as I mentioned, premiums in the deferred futures. The average strip, which is the 6 contracts of the live cattle they're trading today, is at 120. We're selling cattle 111. That's a huge premium. Typically, when you get into that type of situation, over time, the market's going to have a tendency to underperform. It might take 6 months. It might take 8 months. It took a long time for the industry to become current. It'll take a while for it to become uncurrent, but that's a red flag as we go forward through 2018. Just recognize the long-term trend here. You know, again, this particular year, 17, it was down quite a bit because of the currentness, but the long-term trend line is roughly about 5 pounds per year. And so we can produce more product with the same amount of cows on average as you go through time. You know, you think about that trend line, and that's helped gains in productivity. That rate is about a 0.7% over time increase year over year. The pork industry has increased 1% a year. Chicken's 1.3, turkey's 1.5. So you can see where I'm going at as far as some of those productivity gains. But here's just a question to ask yourselves and ask the industry: are we to a point where weights going forward will be stymied to some degree? You're seeing it in the other industries. And we're going to talk about trade here in a minute, but think about the pork industry. This will be the third year in a row where their carcass weights have been flat or a little bit lower. More and more of their production systems are China eligible as we think about exports, which means they don't use ractopamine in their feed products, which means they have somewhat of a limitation from a production standpoint. You're seeing it a little bit in the chicken business today. The consumer wants a slow growth bird, more humanely raised, less antibiotics. Well, it all sounds good, but at the same time recognize it does have some limitation from a productivity gain from our industry. So as we think about what the consumer, whether that's domestically or foreign trade, is going to push back or suggest that we use in our production and the products that we use, it in itself could limit to some degree weight gains going forward. Walking into the trade issue, as we think about trade, it's been very robust the last couple of years in particular. You can see where we're at this year, up 10%, our forecast for next year, up 6%. As we think about imports, down 1% this year, flat next year. That's kind of as we think about imports in particular, a switch from the long-term trend. Typically, there's a very strong correlation. If you harvest more cows domestically, you import less beef. This year and again next year, that's not going to be the case. And we'll talk about that in a little more detail as we think about the relationship of the 90 trim compared to the Aussie product in particular, but also we need to recognize what's taking place in Mexico from a production standpoint. Getting a lot more product in from Mexico than we ever have in the past. But the bottom line is, you think about the difference between 2015 and this year, in just 2 years, the balance of trade has improved 1 billion pounds. And those 2-year difference from a production was 2.5 billion pound increase this year versus 2015. Which means the balance of trade offset about 40% of production increases. And so we think about the market today and what's helping it out. Trade on the beef side is a big part of it, but also on pork and poultry, their exports are up as well. Very important as you think about trade issues as we go forward. Here's just the price relationship between domestic 90% trim compared to product coming in from Australia and New Zealand. And you can see over the last 2 months we finally have gotten above year-ago levels, which tells us that should be a magnet to draw more product in. And it is starting to do that. Australia has expanded. They should have a bigger harvest level next year. And that's one of the reasons we've got trade basically flat as far as imports next year instead of down. And I mentioned Mexico. Mexico this year has imported year-to-date to us about 100 million pounds more than a year ago at the same time. Recognize what's taking place there. They're building their infrastructure, both feedlots and packing. And over time, they will continue to send more product north as we think about beef. Just going to roll through a couple big picture slides as we think about global issues, just to give us a sense of where the cattle production, beef, pork, poultry are around the globe. Here's our producers. And of course, China sticks out like a sore thumb because the pork, they produce over half the world's pork, but they consume it. And they actually export more product on top of that for pork. So as we take that out of the picture and look at it, you can see that globally, we are the largest beef producer, poultry producer, and the third largest pork. So as we think about the global situation and going forward, think about where the grain is produced. It's here and it's South America. Long-term, where is the animal protein going to be produced? It's here in South America. We still are positioned very well in the long run to be the leader in animal protein production. It's produced around the globe. Our market share, we produce close to 20% of the beef globally. We do that with 9% of the cows. What's that tell you about our efficiencies? We're the most efficient as we think about it. Our system and the Canadian system, very similar, North American system, very efficient as we think about producing beef with the amount of cows that we have. And it also shows us as we go around the globe where we have our competition. Mexico stands out a little bit. You know, it's only 3% of the global production, but it's increasing. Recognize that they are, as we talked earlier, increasing their efficiency. And so the export market, it's us and Brazil when we talk about all three proteins together. And you can see that broken down by the three different species. Today, we compete very readily with EU in the pork market. They're very tough competition. That wasn't the case 3 or 4 years ago. Most of their pork used to go to Russia until what happened in the Ukraine. And Russia shut their door to EU pork. Now that EU pork competes with US pork in the Asian market. So those things politically that go on around the globe, we need to recognize do have an effect on our bottom line as far as what's available domestically. And you can see the blue basically from the beef side of things. The bulk of that Indian product, just an explanation there, would be more of that water buffalo type product that is their dairy breed. Not the sacred cow, but the dairy water buffalo. A lot of that product is going into Indonesia. It's going into Vietnam, ending up more than likely in China, the bulk of that, in the back door. So that's where that product is going to. As we think about the importers, again, China, talked about even though they're the biggest pork producer, they still are the biggest pork importer. And you think about Japan, you know, as we think about the destination for a U.S. product, Japan sticks out as we think about that, but Mexico sticks out too. I was just doing a little bit of rough math before I came down this morning, and this year Mexico is going to import about 3.7, 3.8 billion pounds of animal protein from the United States. That's going to be equivalent to over 30 pounds per capita for every Mexican citizen that we're sending south the border. You know, to Canada, much smaller population, the number's pretty close, though, on a per capita basis. They're going to take in about 1.2 billion pounds of product, or about 30 pounds per Canadian. And so we think about that North American trade, it's very important that we recognize that that's where a lot of the destination for our products go, in particular the pork and the poultry side of things. What's trade add from a value standpoint? Here we're just looking at dollars per head. And as you think about that, you know, that's roughly about 17 to 19% of the value of a fed steer or heifer the last couple of years, depending on which year you look at it. And so we're sending about 10% on a weight basis for beef, but when we start adding the dollar value of the drop credits and the hides, you can see that it adds up to a big chunk. Very important from a long-term perspective. Just a quick note on the hide trade in particular. Hides are rather cheap today. They've had a big devaluation this year. Twofold, we're producing more hides both domestically and globally with an increasing cattle herd. And also you're seeing more of the users of hides, you know, whether that's automobile, more so in the shoe and upholstery business, switching into more of the man-made synthetic leathers. So that's a challenge from both. You think about supply and demand for that particular market as we move forward. So the bottom line is, and when we start talking about price matrices and doing our modeling, we always take the supply side back to per capita supplies. Production plus imports minus exports divided by population. And you can see that, yes, it's increasing, but I talked about that value of the balance of trade over the last 2 years, 1 billion pounds. That's taken off. You think about 1 billion pounds divided by our population, that's 3 pounds per capita. Without the improvement in trade, those red bars would be about 3 pounds per capita higher. And our prices, you would have to assume, would have been lower. But the point here also is you think about where we're at today and going into early next year, it's similar to those levels we had in 2011, 12, and 13. And the reason I bring those up, in those 3 years, the fed cattle market averaged about 120. We're going to average about 120 this year, similar to last year. So that's not thrown in pork and poultry, but just something to think about from a big picture standpoint. Let's roll in pork and poultry. As you think about the production gains, and here we're starting to look at all meats, beef, pork, poultry, and the poultry side, we've got chicken and turkey rolled together. And so the top of the blue bar represents what we're producing, which is up against 100 billion pounds today. The blue portion of the bar is what we're shipping overseas, or north or south. And the red portion is what is being left to consume domestically. So you can see that as a trend, a bigger and bigger piece of our production is being exported, isn't it? Which is good, but it also means there's more vulnerability there too, with trade issues. Think about what happened BSC, think about the bird flu a couple years ago for the poultry industry. And so as we think about that trend, it's both exciting because there's 75 million more mouths to feed in the globe every year, and a lot of those folks have more jingle in their pocket as they move from lower caste to middle class. But nonetheless, recognize with that, there's also some vulnerability as we go forward. Also, just look at this chart between 2008 and 2013. Animal protein production in the U.S. was basically stagnant in that 5 to 6 years, wasn't it? Why? Well, think about that corn chart that I showed when we started out. Corn prices were up through the roof, weren't they? With input costs where they were, it drove profitability out of the pork and poultry business in particular, and because of that, there are some years in there where you had year-over-year declines in chicken production, which hardly ever happens, and pork production is pretty flat as well. And so it was that input costs, as we think about it, is a big driver of profitability and production from a long-term perspective. We're looking at the amount of product that we export, the 3 proteins. And from a percentage standpoint, it's about 10% for the beef, it's about 21, 22% for pork, and it's about 17, 18% for poultry. So you roll them together, on average, about 17, 18% of what we produce we're shipping overseas. On a per capita basis, it represents about 40 pounds per capita for U.S. citizens. So it's a big number. Think about those trends as you think about that. Why has pork and poultry been able to expand the way they have over the last couple of decades? Big part is because they've been able to export more of that product. But the challenge is right now that with production up 2 to 3% on average for those 2 proteins lumped together, we can't increase the trade, or haven't been able to increase the trade fast enough to offset that. And that's our forecast over the next couple of years, is that we've still got trade improving, but not at a fast enough clip to offset the increases in production. And therefore, it does leave more per capita supply on the domestic market. Why did the market perform the way it did as we think about going from late 14 at our highs to the fall of 15? A big part of that is about 10 pounds per capita on the domestic market for beef, pork, and poultry. Huge shock to the system as we think about supply. So just think about this as you go forward. We would suggest that's a major headwind as we go forward, is just the big supplies of all proteins as we go forward. Going to shift gears and talk about demand in the next few slides. And again, I think this is a bright side of our business. Here we're looking at a index, retail beef demand index. I would just look at this and say it's mainly formulated on quantity and price. How many dollars are available to move back into the system? Yes, it's coming off its peak because price is coming down faster than production's going up. But nonetheless, historically, there's still a lot of dollars coming into our system. Demand for our product is very good. And so as we start breaking down that demand side, here's something just to think about from a big picture. And here we've got 2 lines. We've got the S&P 500 that's setting records every other day. And then we've got a consumer comfort index on the bottom. And that consumer comfort index is put together every week, and it's 3 questions. How do you feel about your personal finances? How do you feel about the country's finances? And are you more or less willing to have a major purchase in the next 3 months? And you can see it's from the recession, it's trended higher, but slowly. The average Joe out there is feeling better about his paycheck, but not nearly as robust as we think about what the stock market's doing. So generally speaking, we've got a population out there that is feeling better, and we start looking at the data as far as where they're spending the dollars, it would suggest demand is good. But the top-end restaurants that are more highly correlated as we think about fine dining with those expense accounts and the stock market are doing tremendously well, tremendously well. I put this slide up here just to really to provoke some thought as much as anything, and then it ties into the next slide or two. We've got a retail section of our business out there that's changing dramatically and changing very quickly. Think about some of the things that have taken place over the last year or so. Amazon buying Whole Foods and slashing prices. You think about home delivery of groceries. I mean, everybody's going to do that. You think about some of the competition we're seeing between those firms and chains. Got 2 German firms coming in and say, we're going to take market share from somebody. Who's that somebody going to be? Are they going to lay down and do it? No, they're going to fight for that market share. And what that has meant is that we've seen a lot of featuring. In this case, we're just looking at beef featuring activity over the last couple years. From a retailer standpoint, how do they draw people into the store, and how do they keep their dollar sales up, and the meat count in particular, where they're gauged month over month or year over year? It's a lot easier to keep your dollar sales up with an $8 steak than it is a $2 chicken breast. And you get a lot more traffic as well. And so it's been beneficial. This competition has been beneficial, and we would suggest it'll continue to be beneficial going forward. But I would raise a little bit of a red flag longer term. Are we going to start to condition our consumers to buy our product on a discount, on a feature? You know, historically at retail, about 30 to 35% of the product is sold at an unfeatured price for the 3 proteins. Are we going to start seeing that number increase because of the competition out there? Just throw that out there. It's been middle meats and it's been hamburger that's got the bulk of that increase in featuring. And here's just looking at the hamburger featuring as we think about the last couple of years. So we have seen, as we think about the retail side, some things that we feel like have been beneficial to moving the larger supplies of our product. Kind of a messy slide, but I think it's very interesting. You got 2 different lines. The light blue line represents food inflation at restaurants year over year, food inflation. So their inflation is 2% year over year. The dark line is food inflation at grocery stores. That's been negative over the last 18 months and now starting to turn positive. Well, think of what prices have done for all proteins until this year. We had a downdraft in all proteins, didn't we? Milk and eggs as well. And so that has meant that the consumer gradually has, with that type of difference, started to spend a little bit more of that money, his money, back at their grocery stores versus food service. And where I'm going here is the food service business has been pretty tough in some of the segments over the last couple of years, and we'll look at that in a minute. But there's a very strong correlation there. The ebb and flow, if there's inflation in one of those segments or the other, the dollars tend to flow one way or the other. So as we think about food service, and we already talked about the correlation of fine dining and the stock market, you can see that they've done extremely well. Extremely well. At the other end of the spectrum, quick serve, and McDonald's has led the charge the last couple of quarters. They've had a couple of stellar quarters here recently. They're doing very well too. It's the middle section in there, and the fast casual has been generally upbeat, but a big part of that segment has been controlled by Chipotle, and they've had their challenges over the last couple of years with food service or food safety. So that segment has kind of slowed down. The real segment that's been a challenge has been the casual. And most of the same-store sales there have been lower year over year for the last 3 or 4 years. So just recognize when we talk about our consumers out there, retail's doing very well in our opinion, fine dining, quick serve, but there's some segments out there that really have been a struggle as we've seen over the last couple of years. I'm going to roll into kind of the price outlook and some of the things that we look at. I'm going to start out, here's just looking at an average cow-calf break-even. This will be coming from CattleFax survey data. We know that averages don't fit anybody in particular, but just to give you the idea that there's a tremendous amount of range around an average, and if we suggested that on a cash cost, the average producer needs $1.30 on a 5-weight to break even, you've got some folks that can do it at $1 or less, and you've got other folks that need $1.70 to break even, because that's what the data says. There's a wide variety. It also suggests that this year and going forward, profits will get just a little bit thinner, but on average still there for the next year or two. We ask our customers, when they do the survey, a number of questions. And there's one thing that comes back time and time again, and that is, where do you spend more money? Where do you spend less money? Where do you save money? Where are you willing to expand your expenditures? This is where the high return producer, or the folks that are most profitable, are willing to spend more money in. And it's logical. You think about animal health, nutrition, and genetics. Those are areas we don't skimp, do we? For a cow producer, those are areas that we don't skimp because we know they pay dividends as we think about more calves, more pounds, less health issues, all of those things rolled together. Another thing that we look at as far as profitability is in the calf's value. Are there things that we can do with that calf that make it more valuable to the person that's buying them, whether that's a stocker operator or a feed yard? And so there's just a number of items, stair steps to profitability that we've used over time. Source and age verified, there was a number of years ago where that was worth $1.50, $2.50, a hundredweight. You can see that we crossed it out. Well, we might have to put that back on again now. Because if there is a situation where there is a potential for that being a limiting factor for exports along with other factors, there probably is some value there, isn't there, as we move forward. You can see a number of those things: weaned, vaccination, natural and premium programs, source and age, performance history. Performance history is key. It's huge. Knowing how your cattle perform, whether it's the stocker phase, the feedlot phase, that's huge. Because if they do perform, where am I going to come back next year to buy your calves? If they perform good, I've got a little more jingle in my pocket to pass on. So just recognize, if we look at it from a long-term perspective, those are some ways that we can improve the value of our calf crop. What's on the other side of that, in the red bar though? Those that are undermanaged get a discount, don't they? And think about what the industry is doing. It's raising the bar every year, isn't it? As more and more producers do more of these things. So in reality, we have to continue to keep up to times and do more of those things to maintain our advantage in the market. Talk about prices here over the next couple slides. And first, here we're looking at just a fed cattle price over the last 4 years, 3 to 4 years. Think there's been a little volatility in our markets? Tremendous amount, hasn't there? As you think about here where we're at today, the low this fall, which was 7 weeks ago, is at 105. Last week we were at 111. We need to be $3 or $4 higher this week. We'll see where we end up today in the trade. But just think about the last couple years. You know, from 173 high all the way to a 98 low. And then the 98 low last fall to a 145 type high, and then back to a 104, 105 low this fall. Tremendous amount of volatility. And there's no reason not to expect us to have more volatility as we go forward. But I would submit, thinking about when we looked at that corn chart, that as the supply and demand became more known, you squeezed a little bit of that volatility out of the market. I think we're going to see that over the next couple of years. Still going to have some big swings, but we shouldn't have the kind of swings we've had over the last 18 to 24 months. Now, people say, well, where's this market going? I'm just going to throw a couple numbers out there just because of what's happened over the last 40 years. And we go back and say, okay, last year we had a situation where the market broke real hard, and when it breaks hard, it typically has a bigger than normal rally into the next year. If we go back and look at the historicals, years that you have a 20% break from the first half high to the second half low, which we've had this year, we had more than a 20% break, it tells you that the market should have a minimum of a 19% and kind of a maximum, except for a couple outliers, of a 25% rally into the next year's first half high. You do the math, 105 low, 19% takes you to 125. 25% rally takes you to 131. So if you are looking at historical performances as your only gauge, it would suggest the market has potential at 125 to 30 for the first half of 18 highs. Where are the futures at right now for Feb and April? They're 126. It's pricing in the bulk of it right now. And that's a function of the futures market a lot of time, is to try to price in prices before you get there. And so that's something to consider, that maybe the futures are going to price in that range well before we get there, and the cash might not get there when it's all said and done. Just have to wait and see. So that's looking at the cash chart on the Fed cattle. Here's the volatility. This is how many dollars ahead they're worth 1 week to the next. You can see that 60% of the time it's a $20 ahead. 40% it's a $30 a head change from 1 week to the next. And if we're a cattle feeder, and if we can hedge in a $20 or $30 profit, we'll do it all week long, all year long. This is just to show you the illustration that over the last couple of years, this kind of volatility has meant we've had this kind of volatility in cattle values week to week, and there's no wonder. In the green line, that's year-to-date, what percentage we think the cattle and feed number is hedged. We've got a higher percentage of cattle hedged today because of the volatility. Remember, we had some feeding losses in 15 and 16. That was a driver. But also, with that kind of volatility, if we're going to retain cattle through the feedlot section, we need to recognize that risk management is a bigger and bigger part of our management program. I talked about premiums and the deferred futures. And I put this slide up here recognizing that most of you probably haven't seen anything like this before, but just to give you an illustration, this is live cattle basis as a percentage. All we're doing here is taking the cash price minus the futures price. In this case, we're taking a percentage, but that's what basis is. It's cash minus futures. Well, when cash is below 100%, it's been at 90% the last couple of weeks, it tells you that you've got a premium in the deferred futures. April's at 126 today. We sold cattle at 111 last week. That's an 88% basis. If we get a $4 rally at 115, that'd be a 91% basis. That still is historically very weak. In other words, we've got a huge premium out front. Look at the change from where we were just 30, 60 days ago. It's been a huge change. We've had one of the most dramatic basis shifts in history, going from strong basis, where we had a discount board, to now weak basis, where we've got a huge premium in the futures. And that presents, we think, a challenge in 2018 because the correlation, when you've got premiums, what's a cattle feeder going to do? He's going to feed to the premium, isn't he? Today's a good example. We've got the spot at 114 AUK that goes off early next week, and the DEES board is at 121. Why not hedge them in December and feed them into November? The board and the futures will come together at some time and take advantage of that basis. And so the structure of the market is what our concern is, that at some point we'll see that mean weights will increase, we'll lose leverage and currentness, and the market will underperform. But until that happens, as a cow-calf producer, as a stocker producer, or as a feedlot producer, it does offer some hedging opportunities, and recognize it is very beneficial for your calf values as we go forward in here, the premiums, because that's going to support the calf market and yearly market where it is. Here we're looking at a 7.5 weight steer price, similar to what we looked at in the calf earlier. The red represents the seasonal. The blue is a year ago, bear market, straight down all year long. And then the green represents what we've done year to date, which has been fairly seasonal. With the exception, as we think about it in here over the last 30 days, especially the last 3 or 4 weeks, the feeder market has stayed pretty good, just like the calf market. And part of that is because we built some of that premium in the deferreds. Just to give you an idea, and we talk about the next couple of slides, we're going to suggest of the 3 segments, whether we're talking cow-calf, stocker, feedlot, we think about the prices at each of those 3 points. Today, the feeder steer heifer is probably the one segment that's a little bit overvalued, or the others are undervalued. You can look at it either way. But that relationship is a little bit off. And part of that, as you start going to the futures, I talked about the strip for the live cattle contracts, the next 6 contracts, basically the 18 contracts, averages at 120. If we did the same for the feeder cattle for the next 6 active contracts, it's at 153. So the feeder futures going forward is at a level that's very supportive to calf values as we think about it. Here's an illustration. Just looking at a percentage premium, you can see that feeders versus fed premium, that's a very, very large premium. So it tells you if you had a calf crop or you got a stocker operation, and it tells you that if you're a hedger, you'd be hedged more in the feeder contracts than the fed contracts. Even if you're feeding the cattle through the feedlots, that feeder-fed spread is out of line. It's something that's going to have to give. A $33 rollback is more than the average feedlot can accomplish going in 2018 with where corn is. So it tells us at some point that spread has to come back together. Here's another relationship looking at feeder cattle versus the calves. And here it would suggest, calf as a percentage of feeder, that the calf is undervalued compared to the feeder. So that would tell you if you wanted to retain ownership on your calf crop and hedge them in the 2018 feeder futures, that's probably a pretty good bet. Now, they're not as undervalued as they were a year ago at the low from a percentage standpoint, but that relationship is such that it would suggest it's a pretty good bet that retaining ownership on those calves, if you're going to use risk management, would probably pay some dividends again this year. The next couple illustrations, we're going to talk about the cow. And here we're looking at just bred cow prices against the 5.5 weight steer price. And we know they're correlated. You can see that. You can see that the spread is widened out as we've gone to higher prices, which makes some sense. And then we're going to put it into ratio to see if the cow market might be a little bit pricey compared to the calf market. And it would suggest that's probably the case. Now, as long as we're expanding a little bit, that's okay. But at some point when you start to contract, you come back to the long-term average, it tells you that the bred cow market at some point might have some risk once the calf market rolls over as we go forward in here. Cull cow prices, illustration here, we know the seasonal. We're typically running the most cows in the fall of the year. That's when prices are the softest. Interesting to note, and this will tie in with the next slide as well, look at where cow prices are compared to a year ago. They finally are crossing over a year ago, finally, after being undervalued year over year. Well, retained ownership in cows, you know, I think most people on the cow side have thought about that. Depending on where you calve, just recognize the seasonals. Salvage value of a cow, where she's most valuable, the time of the year to avoid. So that relationship, well, it looks good that we're above a year ago level, doesn't it? look at the percentage that the cow man's getting of what that cow is actually worth when you put her in the hanger up. Here we're looking at cow prices as a percentage of lean, and we're using that as a proxy, basically trimmings. Low goes back to the same discussion we had as far as capacity issues in the fed plants. We have the same issue in the non-fed plants as well. We need more cow plants, especially where we're at in the cycle. Otherwise, especially at this time of year, we're going to get a small piece of the pie. I looked at cow prices from a wholesale beef price. They're trading at $15 a hundredweight, hanging on the rail, higher than a year ago. And live prices are basically flat. Who's keeping that spread, that leverage? The cow killer, isn't it? So just recognize where we're at in the cycle. There's some challenges as far as that salvage value of the cow and why that's occurring. Going to finish up just with a kind of a price outlook and a general outlook as we go to next year. And we all recognize things can change, but there's some things I want to leave you with as we go forward today. You know, we started talking about those three things we're looking for. Are the segments above us making money? Absolutely today. Are there enough dollars in our system to be sustainable for the next year, 2, 3 years? Absolutely. The challenge is, where do those dollars fall with some of the roadblocks that we have from a leverage and shackle space concern. Some of the things that we are concerned about, though, as we think about total meat supplies, and recognize we will continue to expand with the profitability that we have for all three proteins. And the dependency on trade, which is good that we've got trade, and we have to continue to have more trade if we're going to stay profitable as an industry. But that does open up some vulnerability as we think about some of those things that aren't in our control. So generally speaking, as we go into next year, we would suggest with bigger supplies that we will see prices soften. You know, you can see that's just kind of a logical trend. You know, that's what we're going to average this year in 2017. We think we'll soften as we go into 2018. Still would have a calf value that's very profitable. So it would suggest it will continue to expand, which we think we will, but at a much slower pace. So generally speaking, I would say a positive outlook, but nonetheless one that has some cautionary flags there. Large protein supplies, trade, leverage, all those things. The structure of the market, I can't underestimate the fact when you have these kind of premiums in the deferreds that typically is not good news for the market when it's all said and done. With that, I'm going to close my portion of the discussion. If there's any questions, we'll take them.
Weather, that time of year, rather than it is anything else. Yep. On 80-degree days and 49.
Yeah. Absolutely, there's a seasonality. You can see that, very obvious, going from 120% to 110. Your point, spot on. My thought, though, is you're still 110, you're at 106. There's a 4%. They're undervalued 4% more than they should be for this time of year. Just like a year ago, they were undervalued 6%. So we recognize the seasonality, but that's the difference between the norm. Good question. Other questions? Okay.